Good evening and welcome everyone to the Power of Passive Investing meetup. We have an amazing guest today, and as always, first I'm gonna share my screen with you guys. So we're gonna go over a few rules for those that are new to our event. We welcome the new folks, and always great to see our existing audience. Let me just share my screen. So again, we welcome new folks. As always, legal disclaimer, the content provided today by our presenter and by us is for educational purposes strictly. We're not selling anything. This is not an investment or any kind of advice. Please consult your own legal, accounting, or CFA, CFP professional for any sort of advice. This is strictly for education purpose only. In terms of the housekeeping, feel free to post your questions in the Q&A or in the chat box, or if you'd like, just raise your hand and I should be able to unmute you afterwards, after the presentation. And if there are any questions, feel free to reach out to Matthew or myself. We're happy to answer any questions. If you folks looking for passive real estate deals, definitely feel free to reach out. I'm happy to discuss with you what we have in the shop, and happy to answer any questions if you have any questions or concerns about the current macroeconomic environment overall. And our presenter is Madhavi Jain with the extremely exciting topic. It's to turbocharge your lazy money. I'm sure that quite a few folks are keeping their money idle right now, waiting on the sidelines for the miracle deals to come in and wanting to invest them. Well, apparently, as you will hear today from Madhavi, there are ways to turbocharge your money and take advantage of them and allow them to work for you while you're waiting for those deals to materialize. A couple of words about Madhavi. She helps her clients with a twofold approach: efficient savings with infinite banking and risk managed investing in a commercial real estate syndication. She's very passionate about educating and bringing high quality offerings to her client with historically recession resistant asset classes such as apartments, self-storage, industrial sector, assisted living, and many more. She is also a fund manager and brings diversified investment opportunities through her fund to her investors. And Madhavi is on a mission to change the financial trajectory of one family at a time, and thousands more to go. And without further ado, I'd like to give the floor to Madhavi.
Thank you so much, Alina. Thank you so much for such a warm introduction. I really appreciate it. And, you know, few things that you said just bring smile to my my face, especially my vision, you know, changing that financial trajectory of one family at a time and thousands more to go. I really mean it. And we'll see in a minute why, right? So first of all, thank you so much again for your welcome, Matthew and Alina. And thank you everyone for joining in today. Let me start by sharing my screen. Yeah, I can share it. That's great. Can you see my screen well?
Not yet. Now we can.
Okay, perfect. So let me just start by. So yeah, so what are you talking about today? Today we're going to talk about turbocharge your lazy money. And why are we focusing on the lazy money, right? So today is, as Alina mentioned earlier, today, you know, most of you are waiting on the sideline for that magic deal, right? We have that trifecta, the high inflation, the high interest rate environment, and just the way, you know, the market is right now, it's just kind of creating that trifecta towards the recession as well. So most of us are waiting on the sideline. Institutional money sitting on the sideline. We need to get that money and start working hard for us and kind of serve a dual purpose. And we will see in a minute what we are. Alina covered my disclaimer, but yeah, just information education purpose only. Encourage to, you know, go back to your legal tax attorneys, etc. If you have any, anything that you want to implement. But Alina provided, my introduction. For me, I'm really, in addition to what she mentioned, I'm a first generation immigrant in this country. And like many, I struggled through the visa issues. And, I was in IT industry. I worked with one of the top 5 consulting companies for about 16, 17 years. And I had to kind of put that screeching halt to my career in 2015. And that's when I started my journey into all this passive world, right? And the moment I kind of started unfolding different things, infinity banking being one of them, and the syndicated real estate being another one of them, I just felt like that restlessness that my community that I come from, the first generation immigrant in this country that are coming from different places, the IT industry, the hardworking doctors, I mean, everybody, they just don't have these tools or time or effort to go look for these tools and go for the conferences and education that we go to. So that's really truly my passion, the education, for my investors, providing them that analytical, super analytical, numbers driven education, because that's how I am. And if something has to come, I have to analyze it and put it into my spreadsheets and see how it works. And Alina, you are also like that. I see most of you, we have so many similarities that we realize over and over again, right? So that's essentially what I'm doing with it. The infinity banking strategy and the real estate syndication, I think that's kind of that 80-20. I know most of us that like to follow and study that 80-20 rule. So I think these are the 20% of strategy bringing in in your financial structure makes that 80% impact, right? Many of us know about real estate syndication, but this is what the infinity banking strategy kind of remains unattended. And this is the reason, there's a reason behind it, right? So in audience today, I love to have a little bit participation from you. Let me know, 3 questions for you today. Have you heard about this strategy, the banking strategy? And have you implemented it? And if not, why have you not implemented it? So please put your answer in, chat box. I would love to kind of see where you're coming from. And as Alina, you were having the problem, I don't see my chat window too. So maybe you can help in reading out the chat if there's, anybody responding there. But please, I mean, I highly encourage, this is an interactive. You're going to have a lot of questions and ask a lot of questions. So this is your time to start interacting, right? So here is the top 3 reasons that I have personally seen that they're not able to implement it, right? Great, Matthew, you are implementing 2023. That's awesome. Yeah. So, the top 3 reasons: I'm too busy to implement it. Then that's one thing. We are always running against the time. I have heard that it takes long time to kind of utilize the benefit, and my priority for my money is to invest it right now. And that's the topmost reason I see it. And then, I just never understood this concept. It's just too complex. I tried to understand it, but I just didn't understood it well enough. And that's where my purpose and my passion is. I was like that. I was super skeptical because I heard that this is a life insurance based kind of a product. So I did not wanted to do it. When I have something like that, I go back to my spreadsheet. I lay out a lot of numbers and scenarios, and this actually proved me wrong. It actually has as a worthy, to consider. And I went so passionate about it that I want to educate people and implemented it in a very strategic way, in a very structured way for them, right? So the answers to that I would say to that to you is that, first of all, you can start implementing it and using it almost immediately. There's some value to it that we can definitely talk about, and I'll show you how. And this is, you would think that, I don't have time, I'm too busy, I'm, have too many things going on, I have my money, it's investing into right now, so I can't do it right now. But this is the best time to implement it, because first, it is tied to a life insurance. So it is tied to your age and health, right? So your age and your health, you're at the best situation right now. It's only going to get downhill from here, right? So it is right now is the right time to implement it, right? And in terms of the understanding, the complexity behind it, the education behind it, let's talk about that. Let's educate ourselves. If we had never known about real estate, we would have never implemented that. And you can imagine where where we would have been without the real estate investments, right? So that is the concept and the usage. That spelling it out for you is what I'm here for. Anything after this, also I will be available. So feel free to utilize my time. I'm available free of charge to you for making you understand further and implement for you, right? So first of all, I like to step back. A lot of people talk about passive income, financial freedom is kind of a tunnel vision. I like to change the perspective because, if you have that narrow focus of lens and you just see a very peculiar situation, but when you step out of that lens, you kind of see, oh my God, this is like whole new world, right? So change your perspective. One thing I would say that, instead of passive income and financial freedom, think about growing, preserving, protecting, and passing your generational wealth. So that's number one change I would say that I would request you to think about and just be an open mind today, right? Why am I saying that, right? So let's look at the foundational principles of our country, right? Some of these financial fathers of our country had millions and billions in today's dollar, right? So they had tremendous amount of wealth. They worked really hard. They had tremendous amount of wealth, right? So Cornelius Vanderbilt, when he passed away, in today's dollars, it was 1.4 million. Andrew Carnegie about 4.8 million, and Rockefeller about $9.3 billion, right? So what happened to this wealth, right? That's kind of a curiosity, that what happened, where are they? Where are the next generations? Where maybe 6 or 7 generations, right? We know, all of us, most of us know Anderson Cooper. He inherited 1.5 million in today's dollars from his lineage, right? So that's kind of sad to see that, billions of dollars comes down to as 1.5 million. This is still a lot of money, but, it's not significant. Carnegie, total respect, so much of philanthropy, so many libraries, colleges, and schools that he built, right? He passed a lot of things to charity, but he passed everything from his wealth directly, right? On the Rockefeller family, on the other hand, and we all know, right, they're doing great. 150 plus heirs, 11 billion wealth, and they're providing millions in charity too. It's not like the charity is not happening, right? So in terms of the strategy, the toolbox that they created infinity banking as one of the toolbox for them. Whenever there is a new baby born, there's that structure created for them. Whenever there is a generation pass, there's like a massive generational wealth that increases after that, right? So it's not just about death benefit, it's about living that life insurance, living that benefit too, right? And we will see how they're doing it, right? So first of all, let's try to understand the wealth potential, right? Many of you here, they have multiple different type of jobs and different potential of wealth, right? If we consider just a 41-year-old age who's maybe retirement 65, current income is about 150K, say a modest 3% in alignment with inflation. Inflation is not 3%, but in alignment with 3%, we'll see that growth is happening, and maybe he has current savings of about 100K, compounding with a consistent return 6%. Again, hard to do, but some assumptions. We need to start with some assumptions, right? So what is the capability of this person, right? So this person actually has a capability of total income about 5 million in his lifetime. So that's like a huge number. And with that savings and increasing, right, its potential for wealth is 10 million. So that's what we are talking about. We're talking about tremendous wealth potential, tremendous money coming through your lifestyle, right? But the lifetime capital is not like you're going to get that 10 million in one shot, right? It's coming in as a tank. So I like to give this representation. The money comes in as a tank, right? So you get a little bit at a time. There is a first regulator, which is that tax that gets to the filter. There is some standard of living expenses. And most of us from time to time try to push up this chute, right? There is like investment and there is savings. We always like to have some money in the bank. I call it a sleep well money because that helps me sleep well, that, okay, something happens to my job, something happens to me, my expenses are covered for at least 3 to 6 months. The grocery bills I don't have to worry about, the mortgages don't have to worry about. That's my sleep well money. My requirement from my sleep well money is that it should never go away. And then most of us, what we end up doing it, we put that money into the bank account saying that, okay, that's FDIC insured, I will never lose that money, it's protected there, right? So that's one tank. The other tank is where we kind of take risk based on our risk tolerance. So there is, from time to time, some evaporation happening there. But on the right-hand side, it's really, really necessary that it is tight lid. There's no evaporation happening. There's no risk. There's zero risk, right? So that's really what, what we have in our kind of lifespan, right? But what is the problem today? What is the problem that we are facing? Let's start a little bit focusing on, and today I'm going to challenge you to shift your mindset. It's like almost a paradigm shift if you haven't heard about this. And if you have heard, if you haven't implemented it, it's like a shift in the mindset. Typically, we are savers. Most of us like to save. We save and we kind of get our bank account to a certain place. And a lot of us don't like loan. I hated loans. So, like when it comes to cars or buying a house, the down payment, we drain our bank account and then we start saving back again. And maybe, buy another investment property or, house. We will drain that, put that down payment, drain it, and kind of keep on doing that. Education, kids' education, spend that money for the college expenses and keep on doing that. So this is how the savers account, the bank accounts look like. We are actually at a decent place most of the time. But what if we do it a little bit differently, right? And what is important is to understand the power of compound interest. Compound interest, as Einstein says, it's the eighth wonder of the world. And why? Rightfully so, right? This is what in the previous slide I showed you. This is the yellow bars. This is what is happening to your bank account, right? What if we just take that money consistently and we start putting it into, bank accounts without uninterrupted compounding, right? So $1,000 per month, uninterrupted 6%. This has a capability of being $1 million in 30 years. That's a huge number. And we never see that because we're constantly doing this up and down, right? So essentially, infinite banking system is harnessing the power of compounding, harnessing that snowball capability and keeping your money rolling, compounded year after year in a very tax-free environment, right? Typically, there are other type of people who are, maybe constantly working on their credit cards, the loan, they take loan for every possible thing, right? So in their bank account, it's again, significantly less money. That's the rate cycle I'm talking about. But now we're trying to get the mentality of increasing that bank balance, compounding year after year, and then leveraging from it instead of people who are just doing the leverage constantly, right? And then the same savings has much more capability of producing outcome for us. And that's what we are trying to achieve with this, right? So it's about borrowing others' money so that your money inside grows compounded, uninterrupted. If one thing that you have a takeaway, take away that uninterrupted compounding word from me today. Just uninterrupted compounding, right? That's the key, right? So let's talk about, what is that Rockefeller's approach? What is that solution, right? So we want to look at a much better savings account, and this can be used for multiple purposes. We will talk about it. But essentially, it is for that sleep well money. First of all, it is for that sleep well money, the savings money. It could be used for your parked money. It could be used for education, your real estate investment money. It can be used for that. But let's start thinking about that foundation of the savings first, right? What is the problem with the savings that you're trying to achieve, right? First of all, you want to, have that cap, right? Never lose that money. So that guarantees needs to be there. What can we achieve with the infinity banking system? We can create a vehicle where we can contribute without any limit. Now, if you think about like educational plan 529 or 401k, they have that limit, right? They also have restrictions on when you can withdraw it at a particular purpose, at a particular age, right? So growing it tax-free, kind of tax deferred, but we call it tax-free because there's a method you can also withdraw from it tax-free. There's a strategy for it. A better interest rate than bank has, money market has started seeing a little bit of uphill right now because the interest rates are going up. But we saw last few years, it was like less than 1%. Right now, it's like maybe about 2.5, 3%, even more sometimes, right? But we want a better rate than banks. We get the high liquidity. This money is available for you anytime that you want it. It is not restricted by age, not restricted by any purpose. It can have that tax-free withdrawals, and we'll talk about that. and it can hold your parked money. So especially for this time when your money is just sitting there eroding to inflation, even if you're getting 3%, what is your real interest rate? Your inflation is about 6-7%, and you're getting a 3%. It's still in a negative when it comes to inflation, right? Your present value of the money is going to diminish, right? So that's what we are trying to do. And why do we want to create a banking policy? Because we want to start thinking like banks. What are the banks thinking? When banks say that, okay, they have that FDIC insured and they are highly leveraged. And what it means that, for every dollar that's in the bank account, they're leveraged at least, 7%, 6, 7%, or sometimes over that, right? They can do that. What do? If you give them $10,000 and say that, okay, this is my money to keep, they give you, say, 1% interest, say $100, and they leverage it out, they give it to like somebody else by, say, 8%, right? So now they have created that arbitrage, the interest arbitrage. It feels like, okay, it's just like they're getting 700K, $700 extra, but it's really the 700% profit, because they shelled out only $100 to you, but they are actually making $800, right? So that's 700% profit. That's essentially what we are trying to do it in our own system. So you want to become a bank so that they don't take that advantage directly, right? So essentially, let's understand the hierarchy of wealth. Maslow had created a pyramid of needs, right? I like to consider the pyramid of needs in terms of financial structure. By the baseline, the bottom is that solid foundation. It's that concrete foundation of your house. It should never, ever, whatever happens, hurricane, fire, whatever, flood, that foundation stays no matter what happens to your house. That's how your foundation for financial structure should be, right? So the savings and protection is very foundational, very strong at the bottom. The protection is not just the protection for your money, but think about what is your biggest asset. What is the asset that brings you the most of the money? And that is you, because you're the one who has that 5 million kind of capacity, bringing in that, the year after year, the salaries and increasing salary, right? So now we can club these two things, two birds in the same stone, that you're trying to create the savings strategy and your protection for the life. Let's put that foundation in a solid foundation so that it never, ever shakes, right? So that's what we are trying to achieve with using that life insurance vehicle, right? So that's your biggest plan. As you start going up, your kind of control is going down, your risk is going up. And this is where we want to invest, right? We do want to kind of have that proportion of risk and reward, and, some direct investment into your education, your home, or direct real estate or business. And as you start going up, maybe syndication, maybe oil and gas. And on top, it says the speculative, right? So speculative is high risk, high reward. Stock market, right? Stock market sits at the top. And most of the times I talk to my investors, their pyramid is upside down. They have their most of the money sitting in the stock market, and their foundation is just so shaky. So that's one thing that you have to remember, that, let's create that strategy. And what happens, right? Once you create that strategy, you use that insurance, you create that strong foundation, that wealth maximization account, which is that infinity banking system. That's your hedge against anything that's going to happen, right? That's your hedge against your inflation, your recession, your emergency, whatever, right? As you start going up, you start creating more opportunity, right? So you will start increasing that foundational money. Maybe if the 30,000 or 50,000 is your comfort, if it goes to like 100K, now you created that 50,000 extra. That's your opportunity money. You put it into the top, anything that you want to do based on your risk tolerance, and you start getting the earnings and the cash flow, and you start keeping this foundational year after year more stronger, more better. And on top of it, it sets, your protection for the wealth for yourself. So in terms of, estate planning and insurance, right? Again, estate planning, I don't provide, but I want you to think about this holistic model, that this is what we want to do, right? So let's talk about the banking strategy itself, right? What is that solution that we talked about? We talked about replacing your savings, emergency money, your parked money. We did not talk about replacing the investment side. The investment side is still what you're doing, right? So going back to our favorite visual, the pipeline, this is what's happening. Now, instead of, on the right-hand side, instead of the FDIC insured bank account, you put whatever money you put it in there in your own bank, that is the high cash value life insurance. Again, I mentioned high cash value life insurance. This is not your ordinary life insurance. Let me repeat that. This is not your ordinary life insurance. This is very specific product with mutual companies that can provide you that lead, that guaranteed protection. There's guarantees in it. This is not your volatile product, even with the insurance companies. This is not your index universal life or anything that's volatile. The risk about your life is with the insurance company. You do not want to take that back. So very structurally created product in that, under that life insurance. So it's not just a whole life product, but the structure has to be right when it's created, right? So we push more cash in it so that it sits there. It creates that vehicle of compounding over and over again. And on top of it, the life insurance, the death benefit sits. And this is that tight lid that I'm talking about, that this has the guarantees in it and some dividends, so some growth and some guarantees, but it's replacing your savings account. And then you can continue having, your risk managed returns in the investments and stuff like that. We are also going to talk about how you can use this money here to start funding your investments. So your left-hand side too. That's kind of the and asset that I call it as. That's the providing you an additional benefit to it, right? So why are we doing this? First of all, it gives you better interest than bank. And then it also provides you that high cash value life insurance sitting in there, the death benefit sitting in there. So the growth is achieved and also the protection is achieved, right? So you would ask me that maybe, yeah, you're right, it sounds right, but why use life insurance for that, right? Because that's the vehicle that, Nelson Nash has realized that it creates this kind of vehicle, the place to put the extra money. So it creates that compounding growth, right? 5-minute life insurance lesson for you. I mean, I think less than 5 minutes, like maybe a few seconds, right? Suppose you come and your attorney or somebody guides you, $1 million is life insurance that you need. You can do two things, right? You can do a term life and you could do a whole life, right? Who decides the minimum? The insurance company kind of decides based on your age, your health, what the minimum is. And who determines the maximum? IRS determines it. This is one of the only things that IRS has control over insurance vehicle. They do not have much control over insurance vehicle. And, this kind of a tax deferment strategy, and sometimes they don't even, this money never sees the day of the light of the taxes. So IRS, really do not like it, but they don't have control over it, right? But they at least put a kind of a top on it that, okay, you can't just provide like millions of dollar money sitting into the life insurance. You need to have some kind of balance about the death benefit. So that's what IRS has done, that they said that, okay, we are going to put some control over it. But with the insurance, that life insurance that we are talking about, right? So say you get your, term life policy about $1,200 a year. And most of the people, there are a lot of education that happened in this country kind of got brainwashed against life insurance. Buy term, invest the rest. Buy term, invest the rest, right? That's what has been going on. The term life insurance companies end up paying, it's astonishing, 2%. They are the one actually on the profit side of it. They never end up paying more than 2% of the money. And that's why, term life they're giving you, because most of the time it's not going to get utilized. That's money down the drain. So you can pay that, or you can pay, say, maximum of $76,000. That's a huge gap in there, right? There is $1,200. Why would I not take a life insurance for just $1,200, and so be it? And why should I just put like a 76,000 if I can possibly? I would possibly put that money. So who are these people putting that lot of money in here, and why are they doing it, right? So first of all, they are achieving all these benefits that we talked about in some time back. They're talking about the tax-free death benefit. They're talking about the tax-free accumulation. They have the tax-free distributions with a strategy. This is available anytime they want, any purpose they want, right? You can store your education money there, and even if it doesn't get for education use for education, you can use it for buying a vacation home, for example, right? It can be used as a collateral in leverage strategy for your investing. It has an automatic credit protection in most states, and it has a competitive rate of return. And it's kind of, there are some additional riders. If you become disabled or something, it's kind of self-completing. So this is what happens, right? This is about, our organization. I'm affiliated with a Paradigm Life, which is the company. We have helped about $4.5 billion to take our money out of the IRS radar and put it into this vehicle. And this is the massive power of this vehicle, right? So it's really for you that how much money do you want in your structure, in that financial pyramid structure that we talked about, to be put it in here so that you can use it for emergency, you can use it for parked money, etc. Who are the people using it, right? We talked about Rockefeller. Do you know that we wouldn't have a happiest place on the earth if it was not for the life insurance? Because Walt Disney's vision for the Disneyland, nobody was even ready to lend him the money. It was kind of revolutionary for his time, right? So he actually used his money in the life insurance system, 50,000, and then he like put some other assets as leverage, and he started Disney World, right? In 1929, as the stock market crashed, Jesse Penny actually used the cash value in life insurance for the payroll of his employees. So he survived that. And, there are many people that we know. So why use this, right? Why use this system? So again, this is your saving system. This is your life insurance protection. Two words in the same thing. And as we are talking about, even if you want to just talk about the saving system, it is safe. It is providing you that liquidity. It is providing higher rate of return than the banks, and it's not getting taxed. So when you're compounding, your tax leakage is not happening. When bank is providing you that 1% to 3%, and you're paying taxes on it, you're not harnessing the growth of that leakage. But inside this system, this is growing tax deferred. So it's growing compounded, including what you would have paid as a tax liability, right? So that's the reason. And I, feel free to please post the questions in the Q&A as you are, getting along, or just start giving me some responses. If you have any questions, if you like anything in what I'm showing, just say that, oh, yay, this is great. I would love that, kind of interaction in the chat box. So that's what we are trying to do. We are trying to create an infinity banking system. And in terms of the structure of the system, what are the steps that happens, right? So first of all, we create that strategic structure. We max fund it, right? So there is like a minimum amount for that life insurance that you can put it in there. But we just don't want that minimum. We want to, kind of put that cash that's sitting in your bank account, move it to your life insurance, so that every year when the insurance companies are providing you dividend in the proportion of the premium that you have in there, you're getting that extra premium, extra dividend for the cash that's just sitting in there, right? So you keep on doing that. You essentially remove this money out of the IRS radar. Excuse me, sorry about that. The next step is that you receive that dividends and the guarantees. There's guarantees in it, and there's a dividend every year. And then you kind of keep on growing it uninterrupted. Again, I said the uninterrupted compounding is the key. Even inside the vehicle, you can take out the money anytime. You can withdraw from the asset as a cash, or you can take it as leverage. And it's simply in the similar terms as the home equity loan. You don't have to sell your home and come out of the house to access the equity in the house. You can go and take a home equity loan from somebody else, start paying that interest only to somebody else, and you can take that money and put it into investing or whatever you want to do, right? So that's really the key here, that uninterrupted compounding. And once that, accumulation is happening, the cash value grows bigger, you start using it for the different purposes that you want to use. Investment, education, emergency, whatever you want to use, right? So again, I cannot insist enough. This is not your ordinary life insurance. This is not a term life insurance. This is a whole life product, mutual companies, which have been existing for over 150 years. And this is that dividend paying high cash value life insurance policy has to be structured in the same way, in a very structured possible way. So this is, kind of living your own life insurance. This is not about death benefit anymore. It also passes the death benefit, but this is the system that has never lost any money in 150 plus years. Remember that cap, that, that the lid on your savings, because that's your emergency sleep well money. It should never go away. So there's that, guarantees built in it. There's not many things that can say put word guarantee in front of it. This system can. No contribution limit, tax-free growth and tax-free distribution through leverage, guaranteed returns, proven dividends. There's a history that way back it can go to, and I can share with you if you want. Easy access to emergency funds, no credit check required, no approvals required. You can create a leverage very quickly. You can implement it and start using it even in the first week if you want to utilize it. You don't have to wait for like 4 or 5 years, right? It becomes efficient after that, 5 to 7 year mark, but you can start utilizing it. Meanwhile, it doesn't have any restrictions on that. It provides you automatic asset protection, especially in terms of like college. Think about that. When you create that FAFSA form and you put your assets in there, they call it out and say that everything except the life insurance, the cash value sitting in here, even if you're saving it for educational purposes, it does not get counted as their money in the education. If they have a 529 plan, they're going to look at it and they're going to say that, oh, they have money in the educational account. Maybe they're not qualified for this grant or these scholarships. So this money is not even seen by the colleges as the cash value, because this is the life insurance money technically, right? And, this is another way of passing whatever you utilize, whatever you don't utilize, you pass it as a tax-free wealth to the next generation. Of course, there's like the federal exemptions limit apply on that, but there are strategies that you can create some kind of trust planning, revocable, non-revocable, where you can start making this as a tax-free asset too. But till that current limit, I think is about 11 million. Till that point, this is a tax-free check. It does not go through the probate. It simply comes to the investors. Sorry, to your heirs. Let's talk about using the same money at 2 different places, right? Again, going back to my favorite pipeline diagram, right? I love visuals. What can I do? So here's what happens, right? If you have that savings money in your permanent life insurance, and you're kind of sitting in the emergency money, your property or business reserves, and now you have the investment money in it, right? What happens when you come across a real estate opportunity, a rental house, for example, right? Typical bank that you empty out that down payment, you put it as a down payment, rest of it is a leverage, and then you go and purchase that asset. Now imagine, how about if you have 100% leverage, right? What will be your return on this one will be? So the strategy is that you borrow funds like your home equity from someone else, and you can borrow it from insurance company, you can borrow from third party, you can pay just interest only payments on that, and then instead of you emptying this account, you make that borrowed payment as a down payment. Now you're 100% leveraged here, and because you had that collateral, they actually give you that loan, right? And inside, you never took out that money, uninterrupted compounding. You never took that money out. So that is growing consistently year after year, snowballing one year after another year. So that's the power of that, using the same dollar at 2 different places. It's growing compounded, uninterrupted inside, and you borrowed against it, showing that as a collateral, and you invested in your whatever investments you want to invest in, right?
Madhavi, we have a couple of questions.
Yeah, I'm actually very logical point, and actually just started looking at them. So first of all, thank you so much for those questions. If you think that you can, you want to have an elaborate question, you please feel free to unmute yourself and ask. But let me get started with one by one.
Madhavi, it's a webinar format, so the folks cannot unmute, but they can.
That's true. That's true.
I can unmute them if they want to.
Okay.
Yeah, we're gonna start with the questions, and it sounds like you can see them, right? So you don't need me to read it to you.
Yeah, I can see them, and I can.
Okay. And if you want to move to the screen where you're sharing your contact for folks to reach out afterwards as when you're.
Yep, absolutely. Let me just put that before actually that, let me just, talk about what are the next steps, right? If you want to implement this, you schedule again that free session with me. We talk about your objectives, because everybody is different. Everybody's purpose is different. And I like to do that. If you're investing, if you want to use it for education money, if you want to use it for retirement and start getting income from it, I look at what your purpose is, what your objective, and I create a structure based on very specifically your purpose. And then once we will have several sessions about this, back and forth, kind of optimizing and tweaking the lot of gears that needs to be changed. And then once you have that structure that you like and you approve, then we kind of go ahead and put that application to the insurance companies, we implement it. And after that, you just kind of grow, utilize it, keep on repeating it. If you under the same policy, if you want to create multiple policies, a lot of people end up creating even as many as like 10, 12 policies in their lifetime, right? So with that, I do have bonus for you. First of all, that's my contact information. You can schedule the call with me. Thinkoutsidethestocks.com. That's my website too. So you can schedule a call with me. And while I'm going to look at the questions here, I will have another bonus for you in a minute. So let's do this. Thank you.
I just typed your
Yes,
website
Brian.
in the chat.
Yeah,
people
thank you
can
so
see.
much. So Brian says that I have heard about Infinity Banking, but not familiar enough with it to try it. Yeah, Brian, the best thing for you is that just create that strategy session. Let's look at what you want to achieve with it, first of all, and then we can create a model specifically for you. We will put in your information at the insurance company, your amounts that you want to create this bucket. I look at it as like a pail of water. So that's the bucket that will create depending on what size you want. We will create it, we will structure it, and again, it's my services for you. It's not any cost, right? Let's take a look at it, and we'll see where you can land, and any of the education further to understand it. I'm very passionate about it, and I pride myself in it, that I say that never get into something that you don't understand. So for me to help you understand it better, that's really my passion. So you're welcome to schedule that call with me. Jennifer says that I have heard about the concept but never seen how infinity banking works. Yeah, I mean, schedule that call, and if we have some more time, I actually have some numbers for you, so I can show it to you if we have more time. Are these policies available without having a physical? So it depends on your health. Because the caveat is that this is based on a life insurance product. So it is based on your age and health situation. Of course, we can create efficient structure at any age. I have created it for 20-year-old. I have created for 55-year-old or even older, right? The physical requirements depends on the insurance company. Penn Mutual is one of the companies which are performing the policies are performing really great, really high cash value. And many of you might actually agree with me if you have that policies. They have a very efficient approval process. If your health is great and they don't have any questions, they will have access to your records, medicines and stuff like that. They actually can approve you without physical. But if they want to do that, they will have a physical test, blood test, or things like that to be done. So yes, most of the time, you will not have it if you are in great health, but if they have questions, they will ask for those physical. The money has to be taken out as a loan. You have an option of taking out your cash value. So you have about 90 to 95% of the cash value that's sitting in there that you can leverage based on that. When you take the entire cash value out, that's where the life insurance, that policy kind of wraps up, and you kind of out of that. It's kind of like, you kind of have a buyout from that. We would never recommend that. And I will show you when we go into that detailed strategy session, why not? Because what happens is that compounding is not only happening to your cash value, but that compounding is happening to your death benefit as well. Typical life insurance, and I keep on saying that this is not a typical life insurance. A typical life insurance will give you a set death benefit, say it starts at 1 million. But this, because it's increasing that cash value, the death benefit also keeps on increasing. And that's the reason we do not want to interrupt neither the cash value nor the death benefit. And you take a simple, loan from either the insurance companies or the outside. And the way I look at it, that you pay simple interest every year on that loan that you're taking out, that leverage that you're taking out, but you are achieving a compounding every year. And after, like 10, 15 years, this growth, which is going like this, it becomes hockey puck. That's the power of compounding. And that's what we want to eventually, achieve. So hope that answers your question. These type of insurance with cash value, my sister was paying and did not accumulate cash after 3 years. Why they are all the same? So it depends on what product you are. Again, every life insurance is not the same. That's what I keep on saying, that First of all, it has to be structured right on the right product. The right product is the high dividend paying mutual companies. So if it is a non-mutual company, drastically changes. If it is not a whole life product with a dividend paying, if it is an IUL, IUL is a completely different story. I can do an hour webinar about IUL and why you should never use IUL for this structure, right? But if it is an IUL, again, that's going to completely, what they provide as a returns and what the market actually achieves. That's completely two different things. It is not your life insurance, like ordinary life insurance, even in the mutual companies as well, because it has to be structured correctly. And let me actually show you why it has to be structured correctly. Yeah, this is the one. So this is what happens in your life insurance, ordinary, right? You put 100% premium towards something that's going to buy you 100% insurance. So the cost of the premium goes directly to the life insurance. When I'm trying to create a structure for you, my purpose is that to reduce this insurance cost significantly, maybe like one third or even less, so that we are buying less insurance and we want the rest 2/3 to sit here as a cash value. Now, many insurance agents don't even do that, or don't even know, first of all, that they can do that, because their commission is going to be based on that 100% premium, right? So I'm part of that group who believe in this structure, and we are okay with reducing our commission because this is what our commission is going to get paid off, right? And very non-significant portion on this one. But that's the reason, I mean, when this money comes and sits here as cash, when next year the insurance company comes and sees that, oh, you have this much of money in your account, in your policy account, that's when they're going to push that dividend on all that money, right? So that's why when I say that it has to be structured correctly, even in the same product, in the same company, with same pen mutual company. And that could be the reason. So Unifil, I could help your sister, ask her to get in touch with me. If that policy is not set up correctly, what we can do, and if you are familiar with real estate transactions, the 1031, we can actually do a 1035 from that policy into a better performing policy. And it doesn't have to, she doesn't have to do that. We can look at first the models that, okay, this is what it looks like. And if she wants to implement it, she can implement that, or she wants to create another vehicle, she can create that. But that's what maybe is happening, and hope that answers your question.
Madhavi, thank you for a great presentation. I have a couple of questions while we're waiting for more. So you talked about the benefits of having infinite banking, but like everything else, there should be some, in addition to pros, there should be some cons. So can you cover what are the cons of this type of policy?
Definitely. So as I said that, the first of all, we have to understand that this is still tied to that life insurance vehicle, right? So your age and your health is significantly important, right? So if you're at an age, say, somebody wants to start doing it as when they're 25, that's much easier to do, much smaller number. But does that mean that if you're like older that you cannot do it? It's just that your contribution to it, because now you don't have too much time before you retire, right? So you have to like increase your contribution so that your efficiency, that snowballing effect that we want to try and achieve for you, we need to do that. So that's first of all the thing that you have to keep in mind. People have a misconception that, oh, I'm too old, I cannot implement it. Another thing is your health. Maybe, sometimes there's just some things about the health that we do not have control over, right? That happens. So they think that I cannot implement it. That's not for me, because even though it's too good to be true, I cannot implement because I have health considerations. We can do different strategies. We can do it on your spouse. We can do it on your kids. It's about creating this vehicle which creates the efficiency for you in terms of that savings, right? So even if you create it on your child and you own that policy, you can do the leverage, you can utilize that policy while you are, you want to utilize that. So you can still do that. Another thing that's important to understand that, there is still going to be some cost about the life insurance, right? Our effort is to reduce that cost as early as possible. When it comes to a typical life insurance policy, when you start seeing the cash value, and if it is like that 100% money goes towards the premium, you will see that the premium that you have contributed to it, because it's going to the life insurance, it has about 15-year point where it's a break even. What that means is that if you have, say, contributed, 200K into that policy, your cash value sitting in there is maybe is about 200K. So that break even happens about 15 years. But in this system, because we are making it more efficient, we are trying to pull that break even much early on. So you will see, depending on the scenario, of course, we created anything between, 6 to 8 years is where the break even point is what our, like, at least reduce it by half. That's our effort to reduce it. Because then after that, what happens is that the life insurance just sits on the top of it. You have kind of achieved that break even of the cost of the life insurance. And now your money is snowballing, your life insurance is snowballing. And that's the effort that we are trying to do for that.
Got it. Thank you. And I'll let you answer another question in the chat before I ask another one.
Sure, sounds good. And by the way, I have, Patrick Donna, who is the founder of Paradigm Life. He has written an excellent book, Heads I Win, Tails You Lose. It's kind of a win-win situation for you. So that's your link to download that button if you want to, go back. And then I'm just going to go back, put my contact information in here again. Just schedule that call with me. Can you
Thank you
explain
for that
again?
pre-gift.
Sorry, you were saying?
I said thank you for that pre-gift. Appreciate that.
Of course, of course. And by the way, there's an audible version to it too. So it's an audiobook as well. So if you're like just listener through the car drive or something, that's good too. Can you explain again the way you can use the cash as a collateral for real estate? Yeah, absolutely. In fact, let me see if I have.
It's great that you use so many visuals. That's always
Yeah, that's what I actually like about all the questions that I get, because if I don't have a visual for something, I'll go back and create one. And
excellent.
this is like the hundreds of slides that,
Yeah,
that's
looks
what
like the PPM. It's as long as the PPM.
I know. And, that's all right. So this is a better representation about it, right? So this is how your bank is, your wealth maximization account or the infinity banking system that you have, right? You have the net cash in here, right? So anytime you have any expenses or any investments, for example, right, what you do is you take the policy loan and then you kind of do the loan payments, right? So that cash value keeps on coming in. You do that same with the investments. If you have investments to do, you take the policy loan and you kind of pay it back and your cash value keeps on getting increasing. So that's another way to look at it. And I'm going to go back to that visual that I had explaining you about the cash value, how to use that for a leverage, right? So again, we have your money sitting in here as a permanent life insurance in your savings account. That's your bank, your own bank. Suppose a rental house is something that you want to purchase. We all love the power of leverage, right? So typically 25% down payment, 75% comes from the bank. Where is that 25% coming from? You empty out your cash from your, say, that FDIC insured bank account. You put that money in here, say 100K property, 25,000 coming in here. You put that down payment, 75K is given by the bank. But instead, what you're going to do is that you're going to borrow these funds from someone else, just like your home equity line of credit. Either you can borrow it from the insurance company or you can borrow from third party. And why are they giving you that money? Because they see that you have, almost like, say, 100K sitting in here and you're just asking for maybe 25K. By the way, that's not the proportion. I mean, you can have up to 90% of your cash value sitting in here. That's the loan that you can have. So you take that 25,000 as a loan and you pay that down payment. Now you 100% borrowed money. Somebody else gave you that 25%. The bank gave you that 75%. 100% is the borrowed money. And now this money, it never came out of your bank account because somebody else, this is OPM, other people's money. Your money is still sitting in here, achieving that year after year compounding. And it still earns next year when the insurance company sees that money, they are going to provide you that dividend and it's going to keep rolling every year after year. Hopefully that helps.
Thank you. While we're waiting for more questions, so my question is, I've seen people opening not just one, but multiple policies. Why
Yes.
is that? Why not add to your existing policy? Why is it beneficial to open multiple?
Absolutely. Great question, Alina. So when I was young, my mom had
You're still young.
when I was a child. When I was a child, my mom used to have a steel can. I don't know if your mom did that, but she used to like take
Piggy
some
bank.
cash, yeah, and stuff it in there. My dad didn't know about this secret stash of hers, right? So she would stuck that money in there, and it was very small, right? I mean, after a while, it will get full, and so she would like keep that hiding somewhere else and create another another steel tin can where she would start stuffing the money. So, like I said, that this structure could be as flexible as you want. So you create this structure, say, for example, to take a minimum of, say, $10,000 and say maximum of $40,000. What happens is after 5 years from now, everybody is going to have a lot of money, more than that they anticipated that they're going to have when they created this structure. And that's what happens. They cannot put more money in it. And by this time, they have realized what that is doing to their money, the cash value, and their death benefit, because not all of the money we're going to finish in this lifetime, right? So that death benefit is also important. So they kind of come back and say that now I want to create another policy because my tin can is now full. I cannot stuff any more in that. And that's when I start seeing, more people creating that second bucket. And in fact, when I see that as a possibility, what I recommend is that you at least go ahead and create a convertible term, not your typical term, a convertible term. And what convertible term does it, that it locks your health. It cannot lock your age, but it locks your health. So even if you get, like really like life-threatening health problem, say 5 years down the line, they're going to just look at the health that you locked in. So you kind of, locking one parameter that's not moving for you. So I recommend that I see your capacity that in 5 years down the line, this is what's going to happen. So let's create another, say, $1 million policy, and then you can convert chunks of it, like 250K, 500K, whatever you want to transfer, you can create the chunks of it at a time.
Excellent. Thank you. A few more questions came in. You're popular.
Oh my God, your audiences, I love your audiences. They're really great.
Yeah, today is very engaging. Like I said, hot topic and excellent presenter.
Thank you so much. I really, really appreciate that. Okay, Michelle, can I open a policy through my LLC to purchase a real estate? So again, this is your saving strategy. You can, as a business owner, you can create like business life insurance on partners, on you. So you can create that. Your business can fund that policy. You're creating that for a saving strategy for your business, first of all. So understand that it is not an investing strategy. It's kind of a detour into investing, right? It's a saving strategy. So your business reserves, for example, right? Emergency reserves for your businesses, payrolls and stuff like that. Right now, where are they sitting? They're sitting in the bank account. So you move that into here. Once you create that bucket in here, and now you go over that buffer that you like to have, then you can put it into real estate. So you get a leverage and you can put it into real estate. So either you invest, I mean, again, that's a lawyer question, whether you LLC would be investing into real estate or who's taking that cash value. So that's kind of a structural point of view lawyer question. But you can create this for individual, you can create it for business partners, and multiple purposes can be used for this. The key is, again, not your ordinary life insurance. Create it with the right company, right product, and right structure. That's really, really important. And that's what I'm here for. What type of person is not a great candidate for this product? I'm yet to see one. But, there are problems always in the life. And, our family motto is we will figure it out. So if there are problems, I try to help and figure it out. Few of the examples I gave you some time back, that because it's a life insurance, and if your health is not there, if you have a severe health conditions, right, you might not get life insurance from any of the companies, right? Does it mean that we don't implement? We have many options. We can implement on your spouse, you can implement on your children. And the purpose is to create this vehicle into something that you can utilize it. You can still own it, that particular policy. So you can still create the leverage, you can still invest using that money, leveraged money that you have. So that's essentially what, the only thing that I would say. But I wouldn't say that it's not a limitation. We just have to figure it out. We just have to create a strategy around it, a detour. I will coordinate my call because I have term insurance and a Roth IRA for my savings. That's great. Yeah. So term insurance, Alina, if you have a few more minutes, can I just share a slide on term insurance? Because a lot of time I get that questions that why not term? Right? Why
If we
not?
can cover it in 5 minutes or less, then we're good.
All right. Let me try my best for doing that. All right. So if you have a term, right? I mean, I like to compare a lot with real estate because most of us are real estate, right? So rent versus buy. Why do we rent? Why do we not continuously keep on renting? Because it's cheaper money. We don't have to worry about property taxes, insurance, etc. Right? Say an apartment, right? We have about 14,000 rent that annually we are paying into it. We purchase our first house, say 225K, about 16,000 principal and interest, right? I'm just taking some random numbers, so don't worry about that. You can even buy a better house with 750K house and 55,000 going into principal and interest every year. These numbers are much more than with the current interest rate. But essentially what I'm trying to say here, right? Say in 30 years, you paid that apartment complex just the rent. That is zero equity and about 430,000 down the drain. You just paid somebody else's mortgage, right? In the small home that you purchased, you had, out of pocket expenses about 360,000. With the 3% appreciation of the home, now you kind of own that home outright. It's about 550 equity. That's your equity in it. In the home, which is much more expensive, it is the same thing, 1.828 million out of the pocket, but now you have 1.8 million equity in there. That's how I like to consider, compare the life insurance. The term life, when you put the $2,000 every 3 years, for example, and then if you have like a typical life insurance where you're paying about 6,500 for 24 years, or you have a banking strategy where you're putting 20,000 for 24 years, right? Much more money that you're putting into the banking strategy. In your term life, that's 60,000 for 30 years. You're not going to get any dollar back from that, right? In the life insurance, it will slowly create that cash value. So, you have 156 out of your cash value, which is about 215K cash value created. That's 1.2% IRR in 30 years, right? But in infinity banking, if you put out 480K, again, scenario is different. This is just an examples only. You have now 1.2 million cash value. That's about 4.8 IRR in 30 years. So that's the difference that I'm talking about. And this is why you should consider. And if you have a term life policy, Yelin, Yenifal, if you have a term life policy, if it is not a convertible term, we cannot utilize it. We will have to create a complete new product and structure for you. But I'll be happy to walk you through and take a look at if it is a convertible. Again, if it is not with the right company, we might not be able to utilize it, but I will try my best to help you out in your situation and see what we can do. Roth IRA, yeah, you can. I mean, Roth IRA is a completely separate vehicle. This is similar to that, but the reason I like this because when you're passing your death benefit, if you have $1 million in cash value, it's almost $2 million death benefit. I mean, any of the retirement accounts, they do not have that capability of doing that, right? So that's what it is. If I take a loan against a policy, will the policy still pay the dividends? So there are two types of insurance companies. There is one called direct recognition and one is called indirect. Little bit complex topic, but I'll simplify for you to spell it out. What it means that some of the companies, they say that if you take loan against some portion of your policy cash value, we will pay dividends a little bit differently. They will still pay the dividends, but they will pay a little bit less amount on just the value that you use. And there are the other companies that they say that we just consider that whatever loan that you take, we consider that people will take loans and they just have one in dividend coming consistently. Irrespective of you take the loan or you don't take the loan, you're kind of getting the same dividend. I like the first one better because the other companies, I think, the work efficiency work is that they assume that you're kind of 100% leveraged. So why take penalty when you're not utilizing it, right? So I like it being my choice that, okay, when I take my loan, then I get only like that little bit difference of the dividend on that portion. Wow, lots of great questions, Alina. This is Such a pleasure to have your audience. It's great questions.
Likewise, it's awesome to have you with us. And I think we are out of questions, or at least out of questions for this hour. But Madhavi, Matt and I want to thank you so much for coming. Excellent presentation, a lot of great content. Folks, feel free to reach out. I posted Madhavi's website, thinkoutsidethestocks.com. If you haven't captured her calendar link, then her calendar link is on her website. So you can reach out to her through the website. Or what are social media handles that you use, Madhavi? LinkedIn, Facebook?
Yeah, LinkedIn, Facebook. So Think Outside the Stocks, I also have a podcast, Think Outside the Stocks, where I actually do talk about this holistic approach. So I'm not just about talking about real estate, but I'll also talk about the banking and, bringing in tax experts, other experts to kind of give that holistic picture. So Think Outside the Stocks on everything, pretty much Facebook, LinkedIn, podcast is the same name as well. I look forward to, to having a talk with most of you. And Alina, it's such a great pleasure and an honor to be here. Matthew, thank you so much to you too. We have so many things in common, Alina. I just feel so comfortable. It feels like such a comfortable place here already. So thank you so much. And I hope I added value to your listeners today.
Likewise, you absolutely did. Thank you so much for being here with us. And we really enjoyed it, Madhavi. And we look forward to bringing you back.
Yeah, and I can talk about the advanced strategies. I can talk about how we can do education and, like even the hedge against the stock market. I would love to come back. Thank you so much.
Sounds good. Thank you so much, Madhavi. Have a great evening, everyone. Take care. Bye-bye.
Thanks everyone for joining in.